Okay, in this video we're going to go through lease disclosures. So this is primarily in the footnotes of the financial statements. And what we're going to do is just walk through the lease footnote for a company. So let's take a look. And the company we're going to look at is Target. And let's start at the top of their lease footnote. So this is footnote 18 for Target. And actually I'm just going to read this to you, so settle in. We lease certain retail stores, warehouses, distribution centers, office space, land, and equipment. So Target is leasing all sorts of stuff. You know, when you walk into a Target store, it's most likely that that space is leased and not owned by Target. Leases with an initial term of 12 months or less are not recorded on the balance sheet. So if it's less than 12 months, they just kind of treat it as an expense during the period. They don't set it up as an official lease. We recognize lease expense for these leases on a straight line basis over that short lease term. Then I'm going to skip the last sentence of that first paragraph. Most leases include one or more options to renew with the renewal terms that can extend the lease term from 1 to 50 years or more. The exercise of the lease renewal option is at the sole discretion of Target, okay? And then we'll kind of skip a bit. The depreciable life of assets and leasehold improvements. So remember, when companies lease assets, they capitalize them on the balance sheet. And so they have to determine a depreciable life for those assets that they're leasing, and then they depreciate the assets over those useful lives. So the depreciable life of assets and leasehold improvements are limited by the expected lease term, unless there is a transfer of title or purchase option reasonably certain to be exercised. So if it's a building and it's expected to have a very long life, but the lease term is shorter than its life, they'll actually depreciate that asset over the lease term rather than over the expected life of the building. Certain of our leases include rental payments based on a percentage of retail sales over contractual levels, and others includes rental payments adjusted periodically for inflation. Our lease agreements do not contain any material, residual value guarantees, or material restrictive covenants. Then they talk about that they actually sublease certain of their assets, so they actually lease out some of their assets. Okay, so I just wanted to go through that paragraph and add some explanation to some of the items there. Now, after these paragraphs, we get down to the actual table disclosures. So let's see the first table that they provide us. And the first table is about the balance sheet. Okay, and so this table is telling us where are the leases represented on the balance sheet of the company. And first, they'll start in the asset section. So Target actually has both types of leases. Remember, there are operating leases and there are finance leases. And Target has both types of leases. And when they lease an asset, they actually debit an asset account on their balance sheet. For assets under operating leases, Target will balance the label, the caption that's called operating lease assets. So they have a separate caption on their balance sheet called operating lease assets, and there's the balance in that account. For finance leases, rather than keeping that in a separate caption on the balance sheet, they just debit buildings and improvement net of accumulated depreciation. So that's just the standard PP&E line item that you'll see on the balance sheet, okay? And there's the balance within that caption that represents finance leases. Okay, so that's where leases appear in the asset section. In terms of the lease liabilities, because remember, when you lease an asset, not only do you have the right to use the asset, but you have the obligation to make the payments on that lease. And so these liabilities represent that obligation. So within the current section of the liability section of the balance sheet, operating leases, so the operating lease obligations are contained within the accrued and other current liabilities caption. Finance leases are on the current portion of long-term debt and other borrowing. So I guess this would classify as an other borrowing. But the finance lease obligations are just lumped in with the long-term debt caption. And here you can see the balances. And then in terms of the non-current portions, they're in similar non-current captions. So non-current operating lease liabilities for the operating leases and long-term debt and other borrowings for the finance leases. Okay, and below the table here, they say we use our incremental borrowing rate based on the information available at the commencement date in determining the present value of lease payments. So remember, when they're setting up the value of their liability, they look at their stream of lease payments ahead and they discount those payments back to today. And the discount rate that they use is their incremental borrowing rate. Okay, that's the discount rate that they use. And they'll have some more disclosure about that later on. By the way, footnote A here, which relates to finance leases, says that finance lease assets are recorded net of accumulated amortization, and they tell you exactly how much depreciation or amortization expense accumulated over the history of those leases has been accrued as of January 30th, 2021 and February 1st, 2020. Okay, so like I said, we're just going to walk through this footnote and see what we can learn about Target's leasing activities. And so now I'm just going to flip back to their balance sheet and we're going to identify some of these accounts. So if you remember, in terms of assets, for operating leases, Target keeps their leased assets in a separate caption. But for finance lease, so this is, I'll just say OP for operating. For finance leases, remember, Target just keeps it in that PP&E balance. So finance leases are in that buildings and improvements balance, and they're also part of this accumulated depreciation balance, finance leases. And then moving over to the liability section, remember, I think operating leases are kept in this accrued and other current liabilities. And then in terms of non-current, the operating liability is kept in non-current operating lease liabilities. And then finally, when we talk about the finance lease obligations, remember they're in the current portion of long-term debt and other borrowings, and then the non-current right below the current section there. Okay, so that's where those leases, the leased assets and the lease obligations appear on the balance sheet. And for whatever reason, Target decides to be a little bit fancy, and rather than just calling it a balance sheet, they call it their statement of financial position. But this is really their balance sheet. Okay, moving down the footnote now. So below that assets and liabilities table, you'll get to the income statement table. So income statement information. So as Target is leasing assets, that costs them, right? They have to make payments on those leases. And for an operating lease, the expense is pretty simple. It's just a straight line lease payment. And the caption that payment goes into is SG&A, Selling General and Administrative Expenses caption on the income statement. And there's the amount there for 2020, 2019, and 2018. Finance leases, as you remember, is a little bit more complicated. The expense is broken up into two components. First is the depreciation and amortization of the asset, okay? So that asset has a useful life, which is limited by the lease term, and they'll just depreciate that asset over its useful life, and that appears as normal depreciation or amortization expense on the income statement. The other element is interest expense on the liability. And so you will see net interest expense in a different caption on the income statement. And you would add those two items together to have the total expense due to finance leases. And then we'll kind of ignore this small amount of sublease income. You see that's a negative number. That's because they actually lease out some space in CVS and they get income from that. But we'll ignore that for the purposes of the lease lecture. Okay, I don't think there were any of these footnotes that I really wanted to highlight A, B, or C. And so we'll move on to this next piece of information. And you might have guessed that the next piece of information is, where does leasing show up on the cash flow statement? Okay. And so these are cash outflows for leasing. Why is it a cash outflow? Well, because we get the right to use an asset and we pay cash for the right to use that asset. So for operating leases, this is pretty simple. So for operating leases, all of that cash flow is just in the operating cash flow section of the cash flow statement. Remember, the expense is pretty simple, right? It's in SG&A expense there, but it's just a rental expense, okay? It's just one type of expense. It's simple, and it's just classified fully as an operating expense. Finance leases are a little more complicated. The cash outflow is the payment on the finance lease. And you may remember that payment, so the finance lease, okay, the payment, and for any of you who own a house, you'll know that your payment has two components to it. Part of it is to pay down the principal, okay, and part of it is just the interest cost. So each payment is broken into two pieces, paying down the principal and the interest cost. And the interest cost goes into the operating section. Okay, but any amount of the payment that pays down the principal goes into the financing section. That's because we treat that lease as a loan, okay? We treat it similar to a loan. So if we're paying down the principal of a loan, we consider that a distribution to financiers of our business. And that's why that portion of the payment goes into the financing section of the cash flow statement. So total financing cash flows for leases are those two numbers put together. Great. And the last element of the footnote for leases are two different tables, okay? The first one is, Target is calling it the maturity of lease payments, but really these are just cash payments, okay? So if you imagine yourself buying Target, okay, you're gonna buy Target, the business, and now you're gonna be the owner of Target. You're gonna be interested to know what future payments are you on the hook for? So what payments does Target contractually obligated to make under these lease agreements? And this table spells that out. So these are all future years here, 2021 and on, and then they just have a big section for after 2025. And these amounts that you're seeing here are just undiscounted payments. Okay, undiscounted payments. And these are just future payments that they'll have to make under operating finance leases and in total. And then after 2025, you see there's a bulk of them. That's because many of their leases last more than 5 years. And so the bulk of the payments are happening after 2025. They'll have a total for all these undiscounted payments. Then for each payment, they'll discount that back to today to come up with the present value of the lease obligation, which goes on the balance sheet. And so they'll discount each of those payments to arrive at present value, and the difference is right here, okay? So after discounting, you remove 652 million of value from those future payments, and now the obligation isn't as painful as the undiscounted cash payments, okay? So there's the obligation for operating leases and the obligation for finance leases. And you can tie that number straight to the balance sheet, okay? That's the number that is capitalized. So 2429 for operating leases, you'll actually be able to, if you calculate it out, agree that back to the operating lease liability. So if you add 211 plus 2218, you will get that liability balance. And similarly for finance leases, the 1766 plus the 88 will give you this number here, this 1854. So that actually is the value of the liability. It's the present value of future cash flows. And then the final table is what discount rate is used to discount those cash flows. And here on this kind of second portion of the table, they gave you the average discount rate that they use to discount those cash flows. So for operating leases, they use a discount rate of 3.54, which remember earlier we learned that was their incremental borrowing rate. And finance leases, they use 3.68%. So they're taking all these future cash flows here and they're discounting them using essentially those discount rates. Okay. They also give you the weighted average remaining lease terms for the different types of leases. Okay, the very final thing I want to point out before we end this video is that, let's see. So this footnote B here, and I think footnote A says something similar. So actually, let's just start with footnote A. Operating lease payments include, so in that table above is included 847 million related to options to extend lease terms that are reasonably certain of being exercised. So they have options to extend, they're reasonably certain to exercise them, so they add whatever that expected payment is into the list of payments there. But those numbers exclude 231 million of legally binding minimum lease payments for leases that are signed but haven't yet commenced. So they don't have the right to use those assets yet, and so they don't put the payments in that schedule above. And the same is true for finance leases, but the issue is larger, right? They're excluding 1.1 billion of legally binding minimum lease payments for the leases that are signed but not yet commenced. So if you're talking about the obligations, the likely obligations of Target, yes, it includes those cash payments on assets that are already being used, but it's also going to include 1.1 billion of additional payments whenever they have the right to use those assets. Okay, so that was a lot of information, but I just wanted to go through the disclosure for Target's leasing activities, and that is footnote 18 for Target.